And welcome again for the week commencing 18 November to Dollars and Making Sense, a weekly podcast about money, investing, and all things finance. Welcome again, Henry Jennings.
Pleasure to be here.
From Marcus Today. So this week, ladies and gents, we're going to be covering off again a weekly review of stocks and shares. I'm going to give you a bit of an update now. As I promised last week, we were looking at Henry's recommendations over the past 6 or 7 weeks now. So it's been a quick flight of 6 or 7 weeks, hasn't it, Henry?
Yes.
So from that perspective, again, what I do every Friday and during the course of the week is download interesting quips that I see in the industry. And Henry, we kicked off another high last week in the ASX.
Well, we were close to it. I think we're 42 points away. We closed on Friday, so nearly at an all-time high, but we had a really good week. Friday session was very strong, up around 59 points at the end of the day, basically on the back of optimism that we're going to see some sort of phase one trade deal, and there were some stories coming out of the US on Friday our time where they were hoping to, they were continuing to talk, and that they were close to a deal. So that was enough to kick us that bit higher last week.
Okay, that sounds great. And again, I think that continues on the theme that we've been really talking about the last number of weeks. Is this immense amount of capital looking for a home, isn't it?
There is a lot of money chasing, and the US has been heavily invested in ETF fund inflows in November have been very strong compared to October. So there's a lot of money coming off the sidelines and wants to buy into this growth story, into this story about a trade deal being done. Whether it is done remains to be seen,
right.
But certainly that is the common theory at the moment. At least we're going to get some sort of phase one done by the US and China.
I think, again, what's interesting when we look at those global impacts and the mutterings of 45, is his pressuring the Fed doing anything positive or negative in that regard?
I guess it keeps the pressure on the Fed. The Fed's been very... they have kind of ignored Trump to an extent, and certainly Jerome Powell is paddling his own canoe at the moment, and the Fed seems to be pretty happy with where the US economy is, to be honest. That they've got a Goldilocks.
It's roaring ahead.
It's not. It's really not roaring ahead. The GDP number is pretty anemic, to be honest. It's about 1.2, 1.3%.
Okay, so the rhetoric's not as positive as what they keep saying.
Never believe the rhetoric. But where it is good, of course, is in jobs at the moment, which is still at record lows, and that is a significant positive. So it's all about the US consumer at the moment. Jobs growth is good. Manufacturing is slowing dramatically. Some states more than others, depending on their reliance in terms of China exports. And GDP has slowed big time, really big time. So the Fed seems to be kind of happy where things are because wage growth is increasing, inflation's in the right kind of spot, and we've got the consumer confidence still out there in the US economy, and also that jobs number. But as far as GDP growth goes, not that stunning at the moment.
Okay.
Not where Trump would like it.
Okay, and again, we're all going to be watching very intently. There's a lot of internal politics happening there, and again, more people going down.
Yep.
There's I think Roger Stone is now being convicted,
Yep.
and so he's going to be sentenced. And again, a lot of Trump supporters and the whole palaver that's going on with Congress at this point in time. It's not something that I think we should be overly concerned with, do you think, or is that something that's going to have a major impact on local stocks?
I think that no other time in our history of the stock market, or certainly I've been around for the last 30 or 40 years, has politics been more important. I mean, at the moment, Trump's tweets are possibly, the most important market-moving things. Now, whether that's rightly so or wrongly so, but certainly that is the overriding wash of the market, sort of whether you're optimistic or pessimistic. It's very much geared to those trade talks, and this is a problem that the US has created. Not to say they're not right in confronting China, but certainly they've created it, and between the two of them, hopefully they can solve it to everyone's satisfaction, and we can get the global growth story back on track.
It's interesting. I often read from my IT missives that there are people that trade and make a lot of hay from Twitter, and so they actually track what's going on.
Yep.
They track the trends, etc.
Yep.
And 45's Twitter account is obviously very, very closely followed, but then they will place and punt bets on, shorts or longs depending on what he's saying.
Yep. It's very much the case. I mean, computer programs are actually programmed to analyse media releases, and they'll look for the word challenging or whatever, or downgrades or guidance of this. Courageous, and the computer algos will buy and sell stocks based on what they're seeing coming over the news wires, whether it's a Reuters feed, whether it's a tweet, whether it's a company announcement feed. This is what these guys search for. This is what AI is really being used for, is these program trades that are done constantly.
So it's not just fanciful stuff that I'm reading about.
No,
this is real,
and this has been around for a long time.
Yeah,
this isn't new now. This has been around 10 years ago.
But this is the PhDs that the big Morgan Stanleys and the investment houses are hiring out of university.
Well, that was
to go and program these kind of these algorithms to look for these gems.
Yeah, well, that was the thing. The smartest minds used to go and work for NASA, but of course, when NASA started pulling back their space program, where do the smartest minds go? And where's the most money is Wall Street. So when you talk about rocket science,
it really is rocket science.
It really is rocket science, because these guys should have been launching rockets to the moon and Mars.
So looking through your Beaks Down Under, and again, we'll put that website up for viewers and listeners to review. It's beaksdownunder.com.au. There we go. So have a look at there. That's Henry's daily missives. And how often do you write for Marcus?
Every day.
Every day.
That's my job.
That's your job.
Beaks
as
is
well
just a side show.
as well as contributing here to Dollars and Making Sense, which we very much appreciate. One of the big things from last week we saw, and again came with a bit of political comment, was Bellamy's approval by the Foreign Investment Review Board to be acquired, and Barnaby coming out and saying he was a bit disappointed. What's your view on your Pac-Man thing as you described in Beaks?
I don't know why anybody had to make a comment on this. At the end of the day, Belamy is a company that basically buys product from anybody they can get their paws on in the organic space. They were buying milk powder from Austria. They buy milk powder from New Zealand. It's not a Tasmanian story, because it long ago outgrew Tasmania. Tasmania can't produce enough organic milk to feed Bellamy's. I mean, it's just not possible. So they've been buying it from everywhere, and all they do is they slap the Bellamy's name on the tin, market the hell out of it, make it look pure and wonderful and Australian. But the reality is they're getting their product from all over the place. It's
Austria and Australia, that's close.
It's close. I'm sure Barnaby didn't quite actually understand the significance. But this is purely a marketing company. It's not unlike A2 to some extent. But Bellamy's is very much purely a marketing company that trades off this kind of pure and Tasmanian and green grass and happy cows, etc. What I find interesting in this whole thing is that Bellamy's had a key license being held up in China by the authorities for a long time, which weighed on the share price and really hurt their business. And then, after the share price is sort of in the doldrums, a Chinese bidder comes along and who's government backed and buys the company, and you can bet your bottom dollar that in a week's time after the deal is consummated, they will miraculously get approved by the Chinese government to sell their product.
Funny how those things kind of work, eh?
Yeah, so that would be the thing that worried me. But as far as national interests go, there's not enough cows in Tasmania, unfortunately, to provide Bellamy's stuff.
So nothing unusual for Barnaby, but he got the wrong end of the stick again?
Well, I think there was, we always get very nationalistic, don't we? FIRB brings out, that's the Foreign Investment Review Board, brings out the best in us as far as putting up walls around investment.
And waving the flag.
Yeah. Bellamy's is a marketing company, same as a lot of these, a lot of these milk and infant product companies are. A2 Milk is not dissimilar, but it does source its products from New Zealand and Australia as well.
Well, again, tailing off, I note with interest that London to Sydney non-stop is 3 minutes quicker than flying non-stop to New York. I'm sure we'll all be losing sleep over that one. So I read that one with a bit of interest anyway.
They're doing lots of tests as well at the moment, because it's a long flight, and it would be 22 hours or something straight.
Yeah.
They're doing a lot of tests on how the human body can cope with it, or best cope with it. So
I used to do a lot of flying in my previous IT life, and one of the longest was Tokyo, Chicago, and that's 14 and a half hours
Yeah.
on top of the normal Sydney LAX, which I did quite a long bouts of, and in my 30s and 40s I was quite happy to do it. I don't know about my 50s and encroaching age. I'm not so sure, but anyway, we move on. Listeners and viewers, one of the things that I'm always trying to, I guess, be clear about is why listen to us. Okay, there are a lot of stock market review programs out there. I've had a look at a few of them out there, and they all talk about the big stocks, and that's great. One of the reasons why I asked Henry to join me in this program is that he specialises in small cap. Now, again, I pulled this really good article out of Livewire during the course of the week, actually penned by AMP Capital, and they talk about performance. And again, Henry, maybe reiterate why you focus on small caps rather than the big guys.
I guess for me, small caps, apart from being an interesting area because they're usually at the forefront of technology, and that's something that interests me, but also they're under-researched. The big caps are heavily researched. All the big brokers cover them to various extents, whereas the small caps, they tend to be far more specialised, and that means that if they're under-researched, there are opportunities there that maybe the market has been missing, and sometimes those opportunities lead to big re-ratings in stocks, big changes in valuation. You know, it's very hard to see you getting a 10 bagger in BHP. That 10 bagger is when it goes up 10 times, whereas in a small cap that is possible. It's not always the outcome you get, but it certainly is possible. So those are sort of life-changing kind of things. You know, you can make some really good money out of getting a small cap right. And in the last couple of years, there has been I guess a procession of small caps that have done really well, and some of the ones that we've
the wax ones that we've talked
about.
Well,
the wax ones. I mean, they're not even. You know, a lot of it depends on your definition of small caps. So, you know, the official definition and my definition could be somewhat different, and each fund manager that specialises in small caps will have their own.
But these were all small companies at one time.
They're all
yes. So I think from that perspective, being able to pick, and again, one of the things, viewers and listeners, we're going to be talking about this particular week is about how you may or may not be able to pick one of these big bangers. And again, I love numbers. You know, numbers never lie, and you know. Well, depending on how you read them.
Although you can torch them to make them say whatever you want.
You can say them. But this particular graph here, for example, which I pulled from that article, has an index at just after the GFC at 100, and the large caps, or the ASX 200 index, has gone up a factor of 150 from 100. But the small ordinaries index over that same period of time has gone to 225. So if you'd pursued a strategy with small caps versus large caps, you'd be roughly double your money better off in small caps than in large caps. And so again, the numbers speak, you know, I think a truer picture than maybe speculative discussion.
They do, but I guess, you know, numbers can be tortured, as I said, into anything you like. So I'd be interested to know, and I don't know off the top of my head looking at those charts, whether that's an accumulation index, because you've got to remember the Australian market is a high dividend paying market. We have 30% of our indexes in banks. They pay a big slab of dividends that's fully franked, and that has to be taken into account. Now, we have an ASX 200 accumulation index, which is at 72,000 or something, which has been on an absolute tear comparable to Wall Street, whereas our ASX 200 normal index, which is just weighted by market capitalisation and not including putting the dividends back into the stocks, is still struggling to make, you know, those all-time highs we saw in 2007. So,
but we're also skewed by a tax system that makes it attractive, and so you know, sometimes when we have these kind of discussions, you know, the external factors become a key element. But you know, what we're also trying to do is, I think, highlight the opportunity of getting above ordinary returns. And they're not going to be achieved, I don't think, as you've rightly pointed out, by sticking with large caps.
No. I mean, small caps do offer that the life-changing or even, you know, income changing possibilities, I guess, in your portfolio. And you shouldn't, if you're looking at constructing a portfolio, you shouldn't be purely focusing on small caps. You need to have a bit of a balance.
Bit of a balance.
But the small cap end can give you a really good tail, and that tail can really wag like crazy sometimes and make you a very happy doggy indeed.
And instead of having single-digit returns on your portfolio, if you're an SMSF trustee, that can push you into doubles quite happily, and that's the difference between maybe going to the Gold Coast instead of going to Europe for your end-of-year holiday.
That's exactly right.
Exactly. And again, some of the key takeaways that I had from these, when you're looking at small caps, is when you're evaluating them, looking at those that are making dollars rather than making promises. And we talked a lot about this, the glossier the brochure.
Yeah.
Okay, that to me is the kind of the companies that are making promises rather than actually delivering. And again, that process of evaluation, focus on earnings, guys. Anybody can stand in front of a camera and chat like we're doing, but when you're investing, you want to be investing in companies that are actually generating free cash flow. Okay, actually making money. And the other benefit, I guess, of looking at small caps, because they're less well researched, is that you're watching this show in the first instance. So you are taking time out of your day to become educated about finance and investing. So that means you're streets ahead of average everyday punter. I mean, last week, Henry, you were talking about the fact that you get frustrated that so many investors are stupid. They don't read their documents. They don't pay attention. And so many times I've sat there as a ex-financial planner myself, and I look at people saying, you know what, just invest in an index fund, because that's the safer way to do it. You can go back to your golf game or watching the footy or whatever you're doing, because trying to educate people that don't want to be educated or can't be bothered to be educated, sometimes it's like teaching a pig to fly. It's frustrating for the pig, and it just can't be done. So again, if you're taking time to listen to this show and become educated, that means there's going to be some gems here for you to be able to look at, go and research, and hopefully make some money in the short or even longer term. Anyway, that's enough about small caps. Again, I picked up another good one about bangers. I love this because, it's that one or two gems. If you're able to pick maybe one, in every couple of years, and it doesn't have to be that many, ladies and gents. I had mine back in the late 90s. I was fortunate enough to go and work for a software company, and we got acquired by Cisco. Now, Cisco just happened to make all the goodies that makes the internet. And for those that were early Cisco investors, that was about a 10,000 bagger, something like that. I'll go back and actually check exactly, because it hasn't been now for quite a while. But back in the internet craze days of the late 90s, early 2000s, those of us that were fortunate enough to be involved with Cisco really ended up making a lot of money, and it was really nice. Thanks for listening to Dollars and Making Sense, a weekly program about finance, money, and investing. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances, and, if in doubt, you should contact an authorised, licensed financial planner. And this particular article about bangers talks about speculation, but again, we talk about, the percent gain since first purchase. So these are ones that we've already talked about. Altium. Okay, Promedicus, A2 Milk, WiseTech, Appen, etc. So these are all about being able to pick those winners. But Henry, one of the first things they talk about here is choose your hunting ground. What does that mean to you?
I guess to some extent, I like to use my eyes, and I think listeners and viewers should do the same. In looking at things that you use every day, or products that you understand, technology that you use every day, the next Facebook or whatever, the new app that you're using, these sorts of things are really useful to be on the lookout for. So I think you need to look. Your hunting ground should be things that you understand, things that you maybe are using, you can do your own research in, and things that are changing the world around us, I guess. I mean, those sorts of the big ones and you've looked at the WiseTechs, the near maps, all these sorts of things. They are affecting some quite big changes within the industries they're in. So it's good, obviously, to do some research, but try and stick to what you understand and what you're interested in, I guess.
And again, picking up a few more of the gems in here, they talk about commodity price swings. So if you're investing in something that is reliant on a commodity price, what's your view on that?
I think it's commodity pricing is it's the same. It doesn't matter whether you're a resource company or you make widgets. At the end of the day, the commodity that you end up making is the important thing. And with commodities themselves, with mining companies that are producing iron ore or whatever, that obviously is traded on an exchange, and you can see that's very transparent. Whereas a widget maker, they could put up their prices because they're suddenly in demand, or they could be hit with competitive pressures and have to cut their prices. So at the end of the day, whether it's a commodity price swing or just a product that gets more leverage, I don't think it really matters so much. Commodities come and go; they come in fashion and out of fashion. A couple of years ago, everyone was buying lithium stocks. Cannabis was another sector, and that's not a commodity where you do dig it out of the ground. But cannabis was a really go-go sector back in 2016. That's now sort of dead and buried.
There's some pun around getting on a high there, but I'm just not going to go there. It's a shocker, isn't it?
But lithium comes and goes.
Sorry.
We've had an iron ore boom that's now waned, of course, and Fortescue have ridden that very well. So every kind of year there's another theme that dominates. This year you could look at tech companies that have done very well this year. So, but yeah, certainly commodities, they come in and out of fashion. We've had rare earth bumps, and Matt Canavan was talking about rare earths today on the radio. I was listening when I was coming in because the government's going to fund it more. So they all come and go at the end of the day.
So the next element this particular writer talks about is high leverage. So leverage is?
Well, it's basically if you add $1 of sales, you want to kind of get that dollar to drop down to the bottom line pretty quickly, and that's why platform stocks, whether it's an Amazon or these sorts of things, are really good, because once you get those dollars coming in the top of the funnel, they tend to just pass straight down because the costs are kind of fixed. And those are the sort of businesses that have been doing very well on the market this year. I mean, something like Nearmap, which has been one of the best performers, they produce aerial satellite images for people to use, and it's a subscription service, and councils and businesses use them. Especially in the States now, and they're far better than the Google satellite photos that you see.
Okay.
So they've already got the technology. So if they sell another $10 million worth of a contract, that $10 million should
just go straight
through the bottom line. So
but
that's where you get the leverage.
Borrowing too, isn't it?
Leverage is about borrowing, but for me, the leverage on, especially if you're looking at small caps and the hockey sticks, is you want them to become viral. Same with Zero. We talked about Zero last week.
Absolutely.
Now that's got significant leverage because it's got the system. All it's got to do is sell more of the system.
Yeah.
And once you sell more of the system, that profit just drops straight through. Debt is obviously part of it in terms of leverage a company has, but really it's the operational leverage, which to me is what you're looking for in one that's going to become massive. If you want something that's going to become massive, you've got to find something that is making $1 now and its costs are $1, but if it made $10, its costs were still $1.
Still be a buck.
And if it made $20, its cost was still $1.
Software is definitely one of the reasons I when I first started becoming involved in software in the 90s from the telco game, I loved it. Exactly to your point. Once you made that CD, you could just press more and more of them, hit the copy button, and you just kept on printing money.
That's where the leverage
is. And again, we are now, I think, blessed, maybe cursed, I don't know, but certainly blessed with cloud solutions now that enables this viral impact. So, say for a company like Xero, they can grow their customer base without having to deploy CDs, without having to do too much more, because it's all there. And again, viewers and listeners, even though you may be older, one of the sectors that certainly I follow because of my kids, but video gaming is exactly that same environment. And if you ever wonder how big that particular industry is, the video gaming industry is bigger than Hollywood and TV put together. Today the video gaming industry, for example, is roughly $120 billion. And if you want to see sales figures, watch what happens when Microsoft releases,
Yep.
a game first day, and they're doing over, $1.5 or more billion in sales in 24 hours. It's astounding numbers, and so that kind of leverage. I was
That's
thinking
leverage.
more borrowing, but that
No.
that kind of leverage, absolutely, I love. Absolutely,
To me, that's the key, is having that leverage to the upside.
So again, picking out, being able to pick these bangers, strong free cash flows. And when I talk about software industry, for example, Fortnite is another one of those interesting video games. It's free. Viewers and listeners, people may not be aware, but it's actually a free program. But how do they make their money? They monetize all the other little add-ons and all the little gizmos that come with it. And when they had their big conference earlier this year, the 17-year-old Brit that won it, I think, won himself about some astounding amount of money. It was about, I think, 10 or 12 million US dollars. It was some crazy for being the best gamer in that particular area. So yes, there's some interesting ones to go, and let's never underestimate the ability of things like that to make a lot of money. And that that uniqueness we've talked about, if you're out there using these offerings and products, and again, something that I think is misunderstood a lot. This particular third point talks about superior management, and I'm not talking now about marketing. I'm talking about the ability to run a good P&L. Being able to understand how to run a good company, being able to understand how to collect money. I mean, one of the things that I always used to look at when I was evaluating companies was not necessarily what price they were selling a product at. That's important. I don't disagree. But their ability to collect revenue. And in my old game, in the telco game, it was all about billing. If you could bill the client and collect the money, you're the guy that won.
Yep.
And many things that befell Telstra's, in the bad old days, was a crappy billing system. And when they got that right, guess what? They started making money. And I guess, that ability to be able to understand where people don't understand, I think gives you that edge to be able to pick that banger. We've talked a lot about this as well when we talk about, doing selections and the like. A2 is a really good example that, the early investors, they were in for some pretty bumpy rides, weren't they?
Yeah, you've got to believe. You've got to believe in the story. If you're out there looking for monsters, you've got to believe that the monster you've caught is the right monster. And at times that belief can be tested. That's
conviction buying. Is that a term that you'd give it as well?
I'd say that's conviction buying. It also could be called stubbornness.
Okay.
But certainly that is part of it. But you're buying into these high risk, high growth stories. And with A2 Milk and with all of these, I mean, we've seen it with WiseTech recently. We see it from time to time in Afterpay when the threat of regulation comes in, or a serious sort of downgrade in terms of price targets that we've seen for Afterpay. So these events, you could consider them bad because they do crystallize maybe some losses. You've got a chart there of A2 Milk. 30-35% losses from time to time.
Yeah.
However, you can also consider them as opportunities, because volatility is an opportunity, to increase your holding,
to buy in,
because other people misunderstand what you see. Now, of course, you've got to have the courage of those commitments to throw more money at something when everybody else is leaving. But to go against the herd sometimes is the most profitable way to go.
Yeah, there's another term that I read about a lot. Sometimes that's referred to as contrarian investing. Would you say that's the case?
Yeah, I think contrarian investing is slightly different. Looking at something like A2 Milk, which you've got there, they've had periods where they have short, sharp pullbacks. Usually there might be some regulatory thing crops up. There was a court case, I remember, where A2 Milk basically were being taken to court over their claims that A2 Milk was actually did what it said it did on the packet. And so they had some legal issues, some question marks over patents, some question marks over various things. And of course, there's also macro things in the market. If the market falls, then maybe they fall as well. Whereas I think contrarian investing is really taking a much longer view of something, as opposed to using the short-term volatility to your advantage, or just having to sweat and have the courage to go through the short-term volatility. Contrarian investing, you really are deliberately going out to be awkward. You are going out there and saying, you know what, everyone else is bullish. At some stage this will turn. I am bearish, so I'm going to buy things that will do well when this turns. And it may take some time for that to play out.
It's often said Buffett invests that way as well. He'll go and buy companies right out of left field and say, you know, that one's going to end up doing well.
Yeah, I think we spend a lot of time in the investment community talking about what Buffett does. And to be honest, that you can't do what Buffett does. It's just impossible. In the GFC, when he bought 10% of Goldman Sachs or whatever it was, and all these big names that collapsed and had this massive strong vote of support for them, and then came out publicly and supported them and everything rallied. You can't do that. It's not possible for the man on the street to say, you know, I think you can buy a little bit.
Bugger, I was looking for that spare $100 billion that was tucked in my back pocket.
But you can't, you can't take a big stake in something and then talk about it, and everyone goes, "Oh, you're Buffett, so we'll follow you." It's very hard. It is
kind of impact, doesn't it? If he speaks, everybody listens.
It is kind of hard to do what these.
I think that gives some good context, Henry. I like that. Thank you for that. Yeah. I think that's a good thing to remember. And I guess rounding out that particular piece of discussion, when we're talking about these bangers, I really like this quote: "To make money in stocks, you must have the vision to see them." So we're talking about that hunting ground, the courage to buy them, so the research and the understanding, and then the patience to hold them.
Yeah.
And patience is the rarest of the three, which is, as a previous investor myself, I was the worst for that. I used to fiddle. I couldn't be patient.
Patience is hard. I met a guy that put 10 grand into CSL when it floated. They're $260.
Wow.
And they were, and that's after splits. The guy's taken that $10,000, which he borrowed from the bank because he had no money at the time. He's never sold a share.
Wow.
It's worth millions and millions. And, that's not, CSL floated in the mid-90s. So it's not that long ago. It's 25 years, but, that's still...
For a 10 grand investment, I'd take it.
That's not bad. So the trick is not only got to have the patience to hold them, but you've also got to have the conviction to not sell them too cheaply. If you really are onto a good thing.
And again, when you talk about conviction with A2, for example, in that particular chart that we referenced, the stock was down at sometimes up to 35% down.
Yeah, no, I remember looking at A2 at about 80 cents. And there was a proposed takeover at $1 and they knocked it back.
Anyway, we roll on. I check out Mark Thirlwell each week at the AICD. He's their chief economist. I've got a great deal of time for Mark. He certainly knows what he's talking about. It's a fair bit in his weekly review, but the thing that I picked up on, and we've been talking a lot about this, is the RBA's updated forecasts from last Friday assume no significant progress on either unemployment or wage growth for the next 2 years, making it difficult for the central bank to reach its inflation target over the same period. We've been talking a bit about this, haven't we?
The central bank will never reach its inflation target. There's no central banks around the world that have, apart from maybe China because of the African swine fever problem, you just can't reach these inflation targets anymore because the CPI has been doctored and neutered during times of high inflation to make it lower, that you can't get the same effect when they start going up, because at the end of the day, the things they measure don't go up that much. The things they don't measure, as we know from ordinary life, go up an extraordinary amount. Insurance, private health insurance, your car insurance, all these things, transport, even the toll roads.
But if you don't measure it, you don't know. There's this blind dissonance, isn't there? Really.
Well, the toll roads are linked to CPI or 4 and a bit %, whichever is the greater.
Who knows? Disclaimer time.
Thanks for listening to Dollars and Making Sense, our weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances, and if in doubt, you should contact an authorised licensed financial planner.
Great. Thanks for that, Henry. And we're running close to time now for this week. It's amazing how quickly we get through our allotted time. But we've been talking a little bit about retail last week. And again, I picked up again some more elements of concern around the importance of retail spending, but also a potential marked slowdown and momentum. So I think the retailers are going to be looking at this Christmas just around the corner with a great deal of interest. And again, you commented last week that good retailers will do well regardless.
Yeah, I was writing about this in the newsletter this morning, and I pulled up the charts of Harvey Norman, which are pretty close to all-time highs. JB Hi-Fi, pretty close to all-time highs. Super Cheap Retail doing very well. Kathmandu doing very well. Wesfarmers, which of course is Bunnings and Officeworks and various businesses like that, doing exceptionally well. Woolworths doing very well. And there's retailers bleating about the retail climate. Well, it's not showing up in the stock prices because the stock prices are doing well. So JB Hi-Fi came out with some great numbers a couple of weeks ago at their AGM. So it's sporadic, it's spotty in retail, but I think generally out there's still a lot of money. There is a lot of money, and the housing recovery is going gangbusters now. From all the people I talk to in the real estate business, they are busy as 10 men.
It's 2 months ago it was gloom and doom, and now it's boom time again.
Yep.
And I guess rounding out that discussion, some of those companies that you just mentioned, we're going to pick up on a separate discussion this week as part of a bit of education around shorting stocks. And a couple of those companies that Henry just mentioned have been the subject of quite intensive shorting. And for those of you that don't know what that means, have a listen to our separate interview on shorting. We're going to be talking about that in just a moment. And to finish up, as I said last week, we're going to be tracking all of Henry's recommendations. And so I've done that this week, and I'll be posting that on our websites and blogs so you can start tracking. Henry, with a view to what we've got in front of us, and we're looking at ASX, PPS, Magellan, we've looked at Macquarie, Zero, Zip, Chimic. Are there companies in there today that you'd be looking at those particular buys that we looked at previously? Would you be looking at those now and maybe reviewing any of those recommendations?
The only one that I think is possibly just doing nothing rather than anything really exciting is probably the ASX.
Okay.
So
right. It's gone fairly horizontal.
The ASX derives its income from trading and from IPOs and issues, and the big issues. Well, one of them was Latitude Financial, which got pulled, and that left a big hole in the ASX.
That's a big revenue earner for them, isn't it?
It is a big revenue earner for them, and there's added risk with ASX as well because I think next year they're bringing in blockchain as part of their settlement procedures, so that's going to be interesting.
I'll be watching that with a great deal of interest, I must say. I have a great deal of interest in blockchain as a technology, not necessarily Bitcoin per se. So that gives us a wrap for this week, commencing the 18th of November. Thanks for listening in and watching our YouTube channel. Don't forget, this is also podcast through Whooshka, and we always appreciate feedback and comments. And again, we look forward to bringing you again next week Dollars and Making Sense. Henry, thanks so kindly for your time.
Pleasure.